Prior to playing the lecture for Chapter 4, you should first read the chapter and complete the preview questions that are found in your course notes packet. Then you should play the narrated PowerPoint lecture. The material in Chapter 4 is covered on an examination that is listed in the course syllabus. The date, time, and place are in the course syllabus, and you actually take the exam in a classroom setting. The Connect assignment is completed online. There are 3 learning outcome statements for Chapter 4. The first is to define financial forecasting and illustrate the process. So we're trying to come up with a measure of how much financing a firm might need over the coming year, or whether it will have sufficient financing, and if so, what options might be available to it. The second learning outcome statement is to actually measure the firm's financial needs using what is called percent of sales forecasting. Some items are measured as a percentage of the firm's sales, and other things have to be estimated in a different way. But percent of sales is fairly common and can be used to estimate a lot of the balances on the firm's financial statements. The third and final learning outcome statement is to look at the sustainable growth rates, to have an understanding how fast a firm can grow without needing additional financing. One thing to keep in mind throughout Chapter 4 sometimes seems to be counterintuitive, but the truth is the firms with the highest sales growth rates actually are the firms that have the greatest financing needs. Well, we might think firms who have sales grow very rapidly would generate a lot of net income, and that may be true, but in order to be able to produce a large increase in sales, firms often need a lot of assets. So if a firm forecasts a 50% increase in sales next year, it might have to build a new plant. It might have to buy new equipment and buy a lot of additional inventory before it can even begin to receive the cash those additional sales will generate. So if it has to build a new factory, it probably has to finance that. So keep in mind throughout Chapter 4, it's the firms with the fastest sales growth rates that actually need the most financing. Financial forecasting is estimating the firm's future financial needs. So we'll start by looking at the time period in which the financial planning forecast process focuses. And to do that, we try to put everything together to look at the firm as one large project. The smaller projects for different operational units are aggregated or added together to form the firm, so we can look at the financial needs of the firm as a whole. We'll project an income statement by forecasting revenues and expenses over this planning horizon for which we are forecasting. Then we'll look at the investments the firm needs to make in current and fixed assets that are necessary to support the forecasted level of sales. So if we forecast a potentially large increase in sales, we will probably forecast the need for more current assets and possibly more fixed assets as well. Once we determine the asset needs, then we can determine whether more financing will be needed for the firm or whether we believe the firm will have sufficient financing in place over the planning period that we are considering. So everything starts with the sales forecast. The sales forecast is the key ingredient for forecasting the firm's financial needs over the planning period. Sales drives assets. So the greater the sales growth, the greater the need for assets, because the firm will need more current assets with which to transact if it's going to have more sales. So it would need more cash on hand, more inventory. Customers would owe the firm more accounts receivable and things like that. As well as fixed asset needs are driven by sales, because a higher sales volume would require the need for more plant and equipment and other fixed assets, particularly if the sales forecast exceeds the capacity of the firm's plant and equipment. We'll think about assets being on the left-hand side of the balance sheet, and those are the things that must be financed. Don't get confused and think because cash is an asset, if we forecast a lot of assets, then we have all the financing we need. It's quite the contrary. The assets are the things that have to be financed. So if we forecast more cash, more receivables, more inventory, more fixed assets on the left-hand side, we'll need more financing in the form of debt and equity on the right-hand side. Fortunately, part of the financing needs are taken care of automatically when our sales are forecast to increase. Certain liabilities, which is a financing source, certain liabilities and the addition to retained earnings are also driven by sales, just like certain current asset accounts are driven by sales as well. So as we start to put together the right-hand side of the balance sheet, part of it will happen automatically as the liabilities and the addition to retained earnings are going to increase automatically for us as sales grow. We're going to use percent of sales forecasting in Chapter 4 as our primary forecasting method. We'll use it to estimate levels of expenses, or more commonly for our purposes, we'll just forecast asset and liability balances for the forecast period using percent of sales. Spontaneous items, which include most current assets and certain current liabilities, are those items that maintain a constant percentage relationship with sales. They are said to arise spontaneously as sales increase. So if we forecast an increase in sales for the firm, we will automatically forecast an increase in inventory, for example, a current asset. If the firm is going to have more sales, we will project that it will need more inventory in order to meet the increased sales volume. Likewise, accounts receivable will increase as we sell more to our customers. We will sell more on credit to our customers that we extend credit terms to. So accounts receivable will automatically increase as sales increase. So examples of current assets that are spontaneous would be cash, accounts receivable, inventory, and there are others. Those are just examples. But if a firm is going to have more transactions, more sales volume, it's going to need more of all of those current asset items. Likewise, certain current liability items that increase spontaneously or automatically when sales increase would include accounts payable and accrued expenses. If we buy from our suppliers on credit, and then we would book that as an account payable to our supplier, the more we are going to sell, that means the more we're going to purchase from our suppliers, the greater our accounts receivable would be. Accrued expenses, such as wages payable, indicate that our workers have worked some number of hours and have not yet been paid for those hours. So if we forecast a larger sales volume, we would predict workers would work more hours, so at any point in time during the coming year, they would be owed more in the form of accrued wages. So these spontaneous items increase automatically when sales increase. These are current asset examples of spontaneous items. These are current liability examples of spontaneous items. Discretionary items are those that are not spontaneous, but they change as the result of explicit decisions made by the management of the firm. Discretion must be used. A decision must be made or action must be taken to cause these discretionary items to change. Fixed assets are almost always considered to be discretionary. Sales might increase and fixed assets may not need to increase. It's the capacity, the sales capacity of our fixed assets that determine whether they need to increase when we predict an increase in sales. If the capacity is sufficient for the forecast sales level, then fixed assets may not need to be added, and certainly we would not add fixed assets if it's not necessary because they're very costly. Certain current and most long-term financing sources that are discretionary, that require specific management action, include notes payable, stocks, and bonds. These items increase only if somebody goes to the bank to sign the note payable to get cash for the firm. Stock is issued only if the board decides to issue new stock. The same with new debt. Those things do not arise automatically as sales change. Specific decisions have to be made and action has to be taken for those items to increase. Now, again, current assets such as cash, receivables, and inventory are typically spontaneous. They rise automatically, increase automatically with sales. Fixed assets are usually discretionary because they have to, for a plant increase, has to be designed, planned for, has significant lead time, and it's not something that happens automatically as sales go up. It's something that management has to make happen. Our first example to forecast an item using percent of sales looks at the historical relationship between the item and the sales volume. In this case, we're trying to forecast current asset balance for the coming year. So historically, using the previous year's data, we see that current assets was $2 million when sales was $10 million. Thus, current assets were 20% of sales in the previous year. We see the predicted level of sales is $11 million. It was $10 million in the previous year, and it's forecast to increase to $11 million. To forecast the year 2 sales level, we look at how current assets related to sales previously, 20%, as we saw above, and we simply multiply that percent of sales times the projected sales level for the forecast year, year 2. So if current assets were 20% of sales in the previous year, and we expect that to continue, and we forecast sales to be $11 million during the forecast year, then we project the current assets to be $2.2 million for year 2. So simply take the historical relationship between current assets and sales, 20%, and multiply that by the forecast sales level of $11 million for year 2 to get the $2.2 million. Notice the current assets were $2 million in year 1, and we forecast that to increase to $2.2 million in year 2. That's a 10% increase. We also saw the sales were $10 million in year 1, and we forecast the sales to increase to $11 million in year 2. That also is a 10% increase. So what we'll see is that when something maintains a constant percentage relationship to sales, like we're assuming current assets does, then the percentage change in that spontaneous item, 10% in this example, will be the same as the percentage change in sales, which is also 10% in this example. So a spontaneous item will grow at the same rate that sales grow. That allows the spontaneous item to continue to have the same percentage relationship with sales from one year to the next. So another approach to percent of sales is that we could simply grow current assets and other spontaneous items by the same rate at which sales grow. We could just increase current assets by 10% because we project sales to increase by 10%. So we could take the current asset balance from year 1 and increase it by the 10% projected sales growth rate, and that would give us a projection of $2.2 million in current assets for year 2. The same that we got when we used the percentage of sales times forecast sales. For anything that maintains a constant percentage relationship to sales, anything that is spontaneous, those items could be determined similarly by just growing them at the same rate at which sales are projected to grow. Now, so far the forecast sales level has been given to us, but that is not something that is necessarily that easy to forecast, or something that is easy to forecast very accurately. We might be able to look at the past trend in sales growth and extrapolate that into the future, but other things could come into play, so we might want to use our judgment and ask ourselves, can sales continue to grow at the same rate, or did something drive an unusually large increase in sales growth over the last few years and that will not continue? Or conversely, has sales growth been fairly slow and stable the last few years, but will something cause sales to grow much more rapidly in the coming years? So that's the type of judgment that needs to be factored in. As we said before, fixed assets tend to be discretionary. So it takes overt, distinct management action for transactions to occur in fixed assets. They tend to be large. So we're talking about plant, which could be tens of millions of dollars and expected to last decades, if not longer. So it's extremely difficult for the investment in fixed assets to change exactly as sales change. So the example here, if sales increase by 2%, is it realistic to expect fixed assets to increase by 2%? Probably not. If sales are forecast to increase by 20%, perhaps we could build a 20% larger factory, or if we owned 5 factories, we could build one more. But if sales is expected to grow by, say, 2%, it's very difficult to build on 2% more square footage to a factory. Or if we own 5 factories, 2% would be just 1/10 of one factory. So you can imagine that this idea that fixed assets come in large chunks and cannot be changed in very small increments certainly makes sense. So we tend to think about the capacity constraint. Fixed assets have certain capacity, such as number of units that can be produced or the number of sales dollars that can be supported. So we have our capacity constraint. If the forecast sales level is at or below that capacity, we'll not need more fixed assets. But if the forecast sales level is above our capacity, then we need to decide, yes, we'll need more fixed assets, but how much? Do we need just enough to meet the new forecast sales level, or should we go ahead and make a significant increase in our plant capacity that might satisfy our needs for many years to come? In any case, there's no reason to believe that fixed assets will maintain some constant percentage relationship to sales. In example 4.2, we see in year 1, PDQ had fixed assets of $1 million and sales of $2 million. That level of fixed assets could support sales up to $2.5 million. So the $2 million sales level was well within the $2.5 million capacity. Now, for the forecast, we have to be aware that fixed assets are purchased $500,000 at a time. That is the smallest amount or the smallest increment that PDQ could add on to its plant. So if it's going to add on to its plant, it will cost at least $500,000 to do so. So we want to determine what the year 2 level of fixed assets will be, and go ahead and look at that as a percentage relationship to sales just to see what happens. And we'll do this for a forecast sales level of 2.2 million and then 2.6 million. Remember, the current level of fixed assets can support sales of up to 2.5 million. So at the 2.2 million forecast sales level, the fixed assets would still be the $1 million we had from year one. We will need no additional fixed assets. If that is the case, and the fixed assets are 1 million, and the sales are at the 2.2 million level, fixed assets would be 45.45% of sales. If the $2.6 million sales level is realized, that is beyond the 2.5 million capacity, so we'll need some additional fixed assets. We're not exceeding the forecast sales, the forecast capacity by much, forecasting 2.6 million, capacity is 2.5 million, so it seems reasonable that one small increment, one small addition to the factory would suffice, and that will cost $1.5 million. So at the 2.6 million sales level, the fixed assets would be $1 million. The $1 million from year one plus the single $500,000 increment or add-on to the factory being fixed asset balance of $1.5 million during year two. That is based on the $2.6 million sales level, which would produce a percentage relationship to sales of 57.69%. As you can see, the percentage relationship to sales is certainly not the same, because at the 2.2 million sales level, fixed assets did not change, sales did go up to 2.2 million. There's our percentage relationship. When we cross the 2.5 million capacity, in this case forecasting 2.6 million, we needed 1.5 million in fixed assets, and that represents 57.69% of sales. Now, the equity section of the balance sheet requires us to forecast a retained earnings balance. Retained earnings on the balance sheet is a balance sheet item that carries forward from year to year. So during each year we need to forecast the addition to retained earnings, so we know how much to add to our retained earnings balance from the previous year. Now this seems like a silly definition. Addition to retained earnings equals the net income that is retained, as in retained earnings are earnings that are retained. So we could think about that as it's the portion of earnings not paid out in dividends. Certainly every dollar of net income is either paid out in the form of dividends or retained in the form of an addition to retained earnings. To forecast the addition to retained earnings, we have probably the longest equation of the entire course here. But if we break it down into components, it's not really that difficult. The addition to retained earnings starts by forecasting net income. Projected net income would be whatever percentage net income is versus sales multiplied by the projected sales. If you wish, just cancel the word sales here and you would be easy to remember. This is giving us projected net income. Projected sales times net income as a percentage of sales will give us projected net income as we cancel the word sales. However, not all of the projected net income is retained inside the firm, so we need to multiply that by this area in parentheses here, which is 1 minus the dividends as a percentage of net income. We call this the retention ratio. It's the percentage of net income that is retained. This is the profit margin, is the percentage of sales that end up in the form of net income. This is the retention ratio, or said to be 1 minus the payout ratio. So the projected level of net income is multiplied by 1 minus the payout ratio, or the projected level of net income is multiplied by the retention ratio, which is the percentage of net income that is retained. And that gives us the addition to retained earnings that will add on to the balance sheet item retained earnings. Of course, retained earnings is a financing source. All equity and liabilities are financing sources that make up the right-hand side of the balance sheet. In example 4.3, we want to forecast the addition to retained earnings. In year 1, PDQ had sales of $10 million, and during that year net income was $1.5 million. During that same year they paid dividends of $1 million. For year 2, sales are expected to be $14 million. So we assume that the profit margin and the payout ratios are constant from year 1 to year 2. That would also mean the retention ratio is constant because it's 1 minus the payout ratio. So we're supposed to determine PDQ's year 2 projected addition to retained earnings. This will be an internally generated financing source for PDQ. The profit margin from year 1 is the net income as a percentage of sales. For year 1, net income was $1.5 million, sales was $10 million, so the profit margin was 15%. The retention ratio is 1 minus the payout ratio, or 1 minus the dividends as a percentage of net income. During year 1, the dividends were $1 million when the net income was $1.5 million, so the firm paid out 2/3 of its net income. Its payout ratio was 2/3, and its retention ratio was 1/3 in year 1. So for year 2, we project the net income to also be 15% of sales, the profit margin times the $14 million projected sales volume, or projected net income of $2.1 million. The addition to retained earnings then would be 1/3, the retention ratio of 1/3 multiplied by the forecast net income of $2.1 million. So the forecast addition to retained earnings is $0.7 million, or $700,000. That's the addition to retained earnings projected for year 2. When we finally start to put the entire forecast together, we're trying to determine whether the firm will need additional financing or whether it will not. So the pieces of the puzzle start to fit together like this. The spontaneously generated financing sources, such as accounts payable and accrued expenses and things we saw previously, plus the addition to retained earnings, which we just computed, may not be sufficient to finance the increased level of assets. The financial forecast, when we're putting it together, it's essential to remember that assets are what have to be financed. They're the things we predict the firm will own, and they have to be financed through the use of debt or equity. So sometimes we'll need external financing to be able to pay for the assets that we have forecast on our balance sheet. So the amount of the external or discretionary financing that needs to be put in place is the predicted change in total assets minus the predicted change in spontaneous liabilities minus the predicted change in or addition to retained earnings. Another way to think about this is that the balance sheet balanced previously. So when we forecast an increase in assets, then we know that we have to have enough financing to be able to pay for or finance these new assets. So if your assets are forecast to change by more than the spontaneous liabilities and the addition to retained earnings, you'll need even more financing to be able to afford the other assets that are projected to increase. Example 4.4, we have the Beckham Spice Company. They have the following financial information. Year 1 sales were $12 million. Sales are predicted to increase by 20%, and the capacity of the current fixed assets is $15 million. Here is the balance sheet from year 1 for the Beckham Spice Company. They had $9 million in total assets and thus $9 million in total liabilities and equity. The accounts payable was $3 million of those liabilities. Long-term debt was $2 million, so the total liabilities were $5 million, and then the common equity was the sum of the three components: common stock, additional paid-in capital, and retained earnings. So the common equity totaled $4 million. The total liabilities and owner's equity was $9 million. For the spontaneous items, the percentage of sales has been provided, and that's based on year 1 sales. For example, in year 1, sales were $12 million. Current assets were $3 million. So current assets of $3 million divided by the year 1 sales of $12 million shows that current assets were 25% of sales. Same is true of accounts payable. Not applicable means that percentage of sales is not used to forecast those particular items. And the retained earnings balance will be forecast looking at the profit margin and the payout or retention ratio and things like that to forecast the addition to retained earnings. In year 1, the net income was $600,000 when sales were $12 million. The dividends were $180,000 when net income was $600,000, and the fixed assets supported sales of $15 million. So, as we begin to forecast the balance sheet, we'll start with our sales forecast. Year 1 sales was $12 million, and they're projected to grow at a 20% rate. So we'll increase the sales by 20% from $12 million to be 20% larger. We get $14.4 million for the projected sales level. The retained earnings balance for year 2 is determined by using these items, B through G. It starts with the profit margin. As we've seen before, it was part of our equation to compute the addition to retained earnings. So during year 1, net income was $600,000, sales was $12 million, so the profit margin was 5%. 5 cents of each sales dollar ended up in net income. In Part C, we calculate the payout ratio from year 1. In year 1, the dividends were $180,000 when the net income was $600,000. So the payout ratio is the dividends divided by net income. For year 1, dividends were 30% of net income. In Part D, we forecast the net income to be the profit margin times the forecast sales. Profit margin was 5%. 5 cents of each sales dollar ended up as net income. So the profit margin of 5% is multiplied by the year 2 forecast sales volume of $14.4 million. So we forecast net income in year 2 to be $720,000. In Part E, we forecast the dividends. We forecast $720,000 in net income for year 2. In year 1, the payout ratio was 30%. So 30 cents of each dollar of net income was paid out in the form of dividends during year 1. So we assume that's constant. So the payout ratio of 30% carries forward to year 2. the forecast net income of $720,000 is multiplied by the 30% payout ratio to give us the forecast dividends for year 2 of $216,000. So we predict $720,000 in net income for year 2, with $216,000 of that expected to be paid out in the form of dividends. So in Part F, we can forecast our addition to retained earnings for year 2 as equal to the forecast net income for year 2 minus the forecast dividends in year 2. So we have forecast $720,000 in year 2 net income less $216,000 in dividends that are expected to be paid using our 30% payout ratio. So we predict that retained earnings will increase by $504,000 during year 2. So for Part G, and we'll use this on our forecast balance sheet, in Part G, the forecast retained earnings balance for year 2 will be the beginning retained earnings balance for year 2, which is where year 1 ended, plus our forecast addition to retained earnings. At the end of year 1, the balance sheet indicated $1.2 million in retained earnings. The $1.2 million retained earnings balance from the end of year 1 was shown on the balance sheet 12/31 of year 1. Retained earnings was $1.2 million. So now we see that we expect the retained earnings of $1.2 million at the end of year 1 to increase by $504,000 during year 2 to be a total of $1.704 million at the end of year 2. So in Part H, we're supposed to determine the external financing needs for year 2. We'll start by forecasting those spontaneous items. First, we have the current assets, and we see they maintain a 25% relationship to sales. So with the forecast sales level, we could multiply the 25% relationship to sales by the 14.4 million forecast sales level to predict that current assets will be $3.6 million during year 2. Of course, we could just increase the current assets by the 20% sales growth rate, and they would grow at the same 20% and get the $3.6 million that way. The net fixed assets will not change because we have a $15 million capacity of fixed assets, and our forecast sales are below the capacity. So we will not increase fixed assets, so we project total assets of $9.6 million. Now the question is, can we pay for $9.6 million in forecast assets based on the spontaneously increasing liabilities in addition to retained earnings in the bottom half of the balance sheet? Well, let's start putting together the liability and equity section of the balance sheet to try to determine if we'll have enough financing or if we'll need more. The spontaneous item in the liability section is accounts payable. It coincidentally has the same 25% relationship to sales that current assets does. So that's coincidental. 25% of the 14.4 million sales forecast gives us $3.6 million of accounts payable as our forecast balance. The long-term debt is discretionary, so the percent of sales is not applicable, and we just bring the $2 million long-term debt item across, and we have our total liabilities. Common stock and paid-in capital are discretionary as well, so their balance just comes across on the balance sheet and has not changed. We now know our forecast retained earnings balance will be $1,704,000 as we calculated in Part 4.4G. So the total liability and equity section on the balance sheet is $10,104,000. The question is, can we pay for $9.6 million in total assets out of over $10 million in liabilities and equity? Certainly we can. These are the financing sources. These are the things that must be financed. So we will have sufficient financing sources to pay for the $9.6 million in total assets that we predict. So we will not need to go issue more debt or more equity to be able to pay for the $9.6 million in assets. We actually have $504,000 more financing than we need to pay for the $9.6 million in total assets. Now we may not want to send this balance sheet to our supervisor because it does not balance, but we might want to offer some suggestions as to what we would be able to do during the coming year. Since we have more financing than we need, we could lower our estimated debt balance by suggesting that we retire $500,000 in debt, roughly. Or we could decide if the stock was perhaps undervalued in the financial markets, we might suggest repurchasing $500,000 in stock. Or since we have more liabilities and equity than we need for year 2, we might suggest actually increasing or paying a special dividend that would lower the retained earnings and thus lower the equity and lower the liability and equity balance for the firm. So there are a lot of things we could do to lower the liabilities and equity to get it to balance. What we typically would not do is we would probably not forecast an increase in assets to get this to balance, because if this amount of assets is sufficient to support the 14.4 million sales level, why would we want more current assets? Or why would we want a larger investment in fixed assets? It would just be inefficient. So we probably want to make suggestions as to how to get rid of more financing than we really need to either pay down debt or increase the dividend or repurchase stock or something like that. Now let's examine the sustainable rate of growth. This tells us how fast a firm's sales can grow before it will have to seek additional equity financing or issue stock. And that assumes that it will keep its current financial ratios the same, particularly the debt to total assets ratio or the debt equity ratio, as the book mentions quite a lot. The formula given in the textbook in table 4.9 says this is the return on equity times the retention ratio divided by 1 minus that ROE times retention ratio. But that is if we use the equity for the end of the period. It's much simpler if we use beginning equity. Then the sustainable rate of growth is simply the return on equity times the retention ratio. In the textbook, there's an explanation of that simplification. You'll see that exact formula presented as return on equity times retention divided by 1 minus that. And then the book goes into a discussion about how ROE times retention is often used, but that is the correct formula when we use the beginning equity, okay, using total equity from the beginning of the period. So let's take that simpler approach here and calculate the sustainable rate of growth from the Beckham-Spice example 4.4. The year 1 net income was $600,000 and the equity from the beginning of that year was $4 million. The payout ratio, which we've already calculated, was 30%. So 30% of that net income went toward dividends, and thus retention was 1 minus the 30% payout. retention was 70%. So if we can calculate the ROE based on that net income and beginning equity numbers there and multiply that by the retention ratio, then we will have our sustainable rate of growth using beginning equity. So the ROE was the $600,000 net income divided by the beginning equity of $4 million. So the return on that beginning equity number was 15%. With 70% of that net income being retained, then our sustainable rate of growth was the 15% ROE times the 70% retention was 10.5%. Now, the sustainable rate of growth means that the firm's sales can grow at 10.5% or less, and the firm will not need to issue new stock. If sales grow faster than that sustainable rate of growth, then the firm will have to put more assets in place, and it will need more financing, and that will need to include additional equity financing to keep the firm's debt to assets and debt to equity ratios the same. So again, the sales can grow at this rate or slower, and the firm will not need to issue new stock. If sales grow faster than 10.5%, the firm will need to issue new stock. There's a practice problem for financial forecasting, and it goes through everything we have just gone through to complete our financial forecast. So you're encouraged to do this, complete this financial forecasting practice problem before you look at the solutions, and then check your work and correct any errors you might have made in completing that forecast. On page 42, there's a review of learning outcome statements for Chapter 4 that might help you think about some of the conceptual issues in the chapter, and those solutions are given on Blackboard. Here are the concept review questions for Chapter 4. As always, I encourage you to pause the lecture at this point, read through those, and see if your thinking is similar to mine on these items. Financial forecasting is estimating the firm's future financing needs, and it starts by determining the relevant time period and then aggregating things to measure this on a firm-wide basis. So we take smaller projects and aggregate or add them together and look at the firm as one large project basically. Then we look at the revenue and expenses over the planning period. Look at the level of current and fixed assets that will be necessary to support the anticipated sales level. So decide if we're going to have to make more investments in inventory or plant and equipment or things like that to support our future sales forecast. And then determine what the financing needs are throughout that planning period. If the projected level of the firm's assets exceed the projected level of its liabilities and owner's equity, then the firm will need additional financing because the assets have to be paid for or financed, and they are financed or paid for with liabilities and equity. So if we anticipate more assets or things we have to pay for than we have financing, then we're going to need additional financing. Spontaneous financing includes current liabilities that maintain a constant percentage relationship to sales and are said to arise spontaneously or automatically as sales increase. Examples of spontaneous financing components are accounts payable and accruals or accrued expenses such as wages payable, where the workers work but they aren't paid quite yet. So we accrue some wages and get the benefits from the workers' efforts, but we don't pay them every day. Discretionary financing does not arise automatically as sales increase, but rather are the result of explicit decisions made by management of the firm, and they include long-term debt, notes payable, common stock, things like that, that management or the board must explicitly decide that they want to increase or issue long-term debt, take out a note at the bank, or issue common stock. Those things don't just happen. Management has to make an explicit decision to decide to increase or issue those items. The firm's sustainable growth rate equals the return on equity times the dividend retention ratio, and that retention ratio is 1 minus the payout ratio. So that sustainable rate of growth tells us how fast the firm can grow without having to issue new securities. It's simply its return on equity, or how fast it's increasing the equity inside the firm, multiplied by what is retained. The retained earnings balance is the retained earnings balance at the beginning of the year plus the net income for the year minus the dividends paid during the year. So the net income for the year minus the dividends paid during the year is called the addition to retained earnings for that particular year. Again, retained earnings balance is a balance sheet item that accumulates and carries forward from year to year. The addition to retained earnings is just for 1 year. It's the net income for the year minus the dividends paid during that year. Spontaneous financing sources include accounts payable and accrued expenses, as we mentioned earlier. Spontaneous assets include cash, accounts receivable, and inventory, things that tend to increase automatically as sales increase, and those are going to, of course, have to be financed. Discretionary financing sources include bonds, stocks, and notes payable, things that management has to explicitly decide to increase or to issue bonds or stocks or to go to the bank to take out a note or increase a note payable. Discretionary assets typically include plant and equipment, especially when there is excess capacity, because if there's excess capacity, then sales may be able to be increased without plant and equipment having to also increase, or it may not have to increase as fast if there is excess capacity. In Chapter 4, we learned about percentage of sales financing, and we also learned that the firms with the fastest sales growth rates actually have the greatest need for financing because they typically have to make large asset investments when the sales are expected to grow rather rapidly. That requires a lot of cash and tends to require financing up front. Later on, the cash will flow in from the higher sales and be used to repay the debt or pay dividends to the shareholders if additional stock had to be issued so the assets could be purchased. Now that you've completed the Chapter 4 lecture, you should complete the financial forecasting practice that's found at the end of the chapter in your course notes. Then complete the supplemental homework practice problems found at the end of the chapter in the course notes. The solutions are posted to iTunes U, where I work them using the document camera. And the PowerPoint file that's posted to Blackboard has the answers. So work the supplemental homework practice first, and then check your answers one of two ways. Attempt the blank Connect assignment posted to Blackboard, and then work the actual online Connect assignment. Check the syllabus for the chapters covered and the due date for each Connect assignment, because some Connect assignments cover more than one chapter. And then come to class and we'll go over the solutions to that blank Connect assignment. If you want us to look at your actual Connect assignment, you'll need to print it off or bring your laptop so we may see the actual assignment that you took, and then we'll answer any other questions you might have over Chapter 4 during the scheduled class session. Begin preparing for the exam early by compiling your exam formula sheet chapter by chapter as you go. And remember, we repost each Connect assignment after it is due so that you may work it for additional practice an unlimited number of times. It will generate new numerical problems every time you work it, so you can get unlimited practice on Connect after the assignment is due.